Welcome to our Keynote panel discussion, New Drivers in Institutional and Retail Investing. Please welcome to the stage our moderator, Ryan Lawler, Fintech reporter at Axios Pro, and our esteemed Keynote panelists.
All right, man. Thanks everybody for being here. Today we're talking about institutional and retail investing, and we have all of these great participants that are on the front lines of investing. So I guess to start, the investing world has changed a lot, even in just the last couple of weeks. So I'm wondering, you've all been through multiple cycles, up cycles and down cycles. How does the jitters in the market affect your business, and how do you support investors in the down times as well as the good times?
You want me to start?
Sure.
Okay. So our business, I'm the CEO of Betterment, really thrives actually in turbulent markets, in large part because tax loss harvesting is the thing that we do best. And so the value creation really jumps off of, volatility. But from an investment perspective, we really have a clientele that believes in the long term, believes in diversified, long-term, steady investing, and that long-term wealth creation is really about weathering the storms and not getting distracted by fear-induced headlines. So I like to say, I don't really worry about it because on average and over time the market goes up, and that's what we preach to customers.
Anyone else?
Hi, everyone. My name is Michael Blaugrund. I'm the CEO of DriveWealth. And DriveWealth is a global fintech platform that provides brokerage as a service. So we power the trading experiences of about 100 B2B partners around the world. And for many of those partners, there's been tremendous tailwinds to have their assets in dollar-based securities. And so over the long run, to your point, I think that trend is likely to continue. About 2/3 of the world's market cap is in US listed stocks. But with respect to activity levels, I think retail often will buy the dip if the dip is, reasonably short. I think if we see a consistent trend of down, then you're going to begin to see activity dwindle. But as of now, we've not seen that. Levels are quite strong.
Leif and Brian, both of you, deal with the retail market. So how do you deal with this?
Yeah. First off, just one step back, if you look at literally what happened the last few weeks, and you look at, especially what new administration, and I often call Trump a little bit like the president of A/B testing, who likes to look, put stuff out into the world, see where we react, iterate on it, get some feedback, then put something more official out, and so on. And that just is obviously, something that creates a lot of uncertainty. And generally speaking, markets obviously don't like that, right? And in markets, you want as much as a clear path as possible. If you can forecast it, the better it is. And that's literally what we've been seeing, right? And really what we've also been seeing is that based off that, whenever markets dip, obviously retail comes in, they deposit. This month is likely going to be our, strongest deposit month in the history of the company, just because people come in and deposit, more funds. And then I think the other thing is that, especially this generation, I think there is just this notion of trying to build more a portfolio for the long haul because they still have some time left in their life to actually build their portfolios. And also I think that's why they kind of think about this notion of buying the dip, because they feel that they can just continuously add to the portfolio and kind of build it up over the long term. And so generally speaking, we see that these moments can actually be quite good, and because most people will literally have more of a long-term view on it, and they're not necessarily just trying to time the markets in and out, other than obviously trying to buy the dip if something seems suddenly incredibly cheaper than maybe what they've bought last week.
So I'm Brian Barnes. I'm the founder and CEO of M1. Been at it about 9-10 years, and so I've seen a lot of 10% corrections over that time frame. I do think when you zoom out, the US stock market brokerage industry is still 40 trillion bucks. The US banking deposits is 20 trillion. About 95% of it is still in the incumbents, and I think 99 maybe. The fintech companies are trying to be that next generation, to be the financial incumbents of the next generation. And so, if you're looking at $60 trillion and 59.5 is still in the incumbents, the 10% market moves don't make that much of a difference. It really is, are you getting the person who's going to be the affluent customer of tomorrow? Are they making it your primary financial institution? Are they connecting with you over long periods of time? And are they systematically adding with their paycheck and investing over long periods of time? And so, in 6 months, we're not going to look back at the second week of March as a big deal in that sort of market shift.
Okay, well, on the bigger term or the longer term, then tell me, how are you attracting those customers, and what are they looking for? How are you serving them in particular?
We sort of look at it as, I don't know, there were like the Morgan Stanleys and Merrill Lynches of the early 1900s. Schwab and Fidelity came out in the 1960s and 70s with Vanguard, and were sort of better product, better pricing, potentially better UX, what that meant at that time. And I think there's a opportunity for that to exist in the 2020s. And so, I think there are a lot of fintech companies trying to capitalize on that opportunity. A handful will succeed. And, I think it's ultimately you're trying to deliver a significantly better user experience writ large. I think that's some combination of better product, better pricing, easier to understand, more accessible, you name it, on the dimensions that matter. But it really is, someone who is coming into wealth saying, I can either use a tool that was created and designed 20 years ago and is the legacy of a lot of tech debt, or I can use this modern interface that was sort of built with technology that came about in the last 5 years. And I think a lot more are gearing towards that end of the spectrum.
The way we kind of think about it is there's a, call it, millennial, late stage Gen Z type of customer. They did grow up with gaining financial literacy way early in their lives. And due to that, we think that they are self-directed first. Not self-directed only, but they're self-directed first. And this is because they have way more confidence in their abilities. They've learned potentially with crypto even early on. They've learned because they had access to brokerage accounts early in their lives with lower minimums, et cetera, et cetera, et cetera. And that's how they grew up. And therefore, they start investing in their 20s potentially, and not when they were mid-30s getting their first child or so on. And that, I think, creates this opportunity in the space where if you look at the old world in kind of like brokerage, wealth management, it is very binary. It is either you do everything yourself and you log in and you have a beautiful table with buy buttons and a bunch of charts, and that's your brokerage app or your brokerage platform, or you have a financial advisor that does everything for you. And if you look at the incumbents, that's literally how the businesses are set up, right? If you look at Schwab, you have the financial advisory piece of the business and you have the self-directed brokerage piece of the business. It's very binary. And if you look at it as it's more of a spectrum, and you're kind of filling up that spectrum, and technology can really help to really build that, right? And so if you look at it as a spectrum, then in the middle of it, you essentially have this concept which we call guided investing. And guided investing is suddenly where I'm the user, might have an initial thought or idea, but then the system or AI obviously can play a massive role here. It becomes more of like my sparring partner, and so we kind of create my portfolio, so to say, together. And it might be handed off from there and then being automatically managed, or something is being put on autopilot and I still approve certain things, whatever it might be, but it's much more the spectrum. And so where the user comes from being more of a self-directed user because they're way more confident in their abilities as an investor, and then from there, as they build a portfolio, parts of it basically become more managed, but that doesn't mean a human being needs to do it for you fully. And that's essentially how we look at the platform, trying to build that out, so kind of build out that spectrum over time. Versus living more in this like old school binary world.
I think consumer expectations from other parts of people's lives have found their way into the financial services space. We have a always on instant gratification expectation, whether we're buying groceries or like trying to meet a romantic partner. I mean, these things, we expect to be able to use our phone and get what we want right now. And so markets now being available 24 hours a day, the ability to buy a fraction of a share and compose the portfolio that you want, regardless of how large the scale of your assets might be. These are sort of further expressions of what I think are just a broad societal shift.
I mean, I would agree with that, but I would say that's the biggest challenge we have as an industry, because I think that by and large, that's not leading to great outcomes. And so I would agree with Leif as well that it's a spectrum. I would insert humans into the spectrum as well, but I do think the spectrum ranges from self-directed to managed. And while I think there is a confidence emerging with this generation, I think in some ways it's a misplaced confidence, right? For anyone who saw the movie Dumb Money, it doesn't always end well. It's okay if you are a customer who has enough means to lose that risk capital. But I think that one of the tough lessons that the sort of dopamine hit of this generation, the sort of social mediaization and the gamification of investing, I think conflating gaming and investing is really not going to be good for long-term wealth creation. And so while I think it is an important part of the mix, I definitely agree. I think that's our biggest challenge, is how do you take consumers who think they know it all and give them enough guidance, enough advice, enough encouragement and support to get them to a place of kind of good habits early enough that they can then benefit from the power of compounding and get started early.
To that point, given that gamification, there was a regulatory crackdown on those types of investing options. And I wonder, under the new administration, there's been a lot of upheaval on the side of regulators. I'm wondering where you see specific gray areas or hurdles that you're going to have to navigate as you put out new products or provide things to your users.
So because I'm really focused on this long-term investor, I think a lot about retirement, actually. And the great news about retirement as it relates to the regulatory landscape is that it's very bipartisan, because both sides of the aisle really expect that private companies and private citizens are going to be more responsible for their own retirement, no more pensions, Social Security is maybe not funded to do what we need it to do for that next generation. And so therefore, it's going to be incumbent upon companies, I think, to support the wealth building journey of their employees. And so there's been actually really great regulation on that score, Secure Act 2.0, that has encouraged companies that didn't provide retirement to do so and required it, but it's been more of a prospective legislation. I think there's an opportunity for that legislation to actually go backwards and do even more for people who already are participating perhaps in the retirement economy, but not to the fullest extent. So I'm kind of focused in that area.
I would also argue that for any of our businesses here, there's always this sense of how tempted are you of driving your short-term ARPU. And I think that's what you've seen with the more gambling type of trading apps out there, is where people just, those companies just got addicted to short-term revenues, so to say. And I think in our business, you have to always balance your ARPU and your lifetime. And I think it's very easy to bring your ARPU up by driving people to a bunch of gambly, risky assets, because you can make some money on that pretty quickly. Call it short-term options trade, CFDs in Europe, all that kind of stuff. Betting, in various forms. But in our sense, we believe that is just not a good business, because also just from a pure business perspective, just rational business person, you will look at that and be like, these customers will burn out. And so you're running a company that has lifetime of a year and a half to 2.5 years. So you have to refurbish your entire user base every few years. And that is not a great business, really, right? And if you look at some of those, filings of some of those companies who are trying to SPAC or go public or whatnot, and you see, 30 million users and 500,000 are funded or something, and be like, that is not a funnel issue, there's a churn issue. And it's because it's a gambly product. And when we look at this, this balance is really what's important. And so what we look at it a lot is the sense of trying to really balance your need for short-term revenue that you also need as a business for your paybacks to work and all that stuff, with making sure that you build a user base that sticks with you for decades and you have decade-long lifetimes, so that you also just have a business where churn is not really the issue. And in the long term, that is just a better business to build than trying to just fish for the short-term ARPU, right? And I think if you do that, you're automatically also focusing on customers who are a little bit more sophisticated, who have a little bit more money, or a little bit more serious about what they do, because you're not in the business of selling lottery tickets, you're in the business of helping people build their wealth. In order to do that, you must have some money left over at the end of the month in the first place, right? And so I think that balance is what anyone in our business really has to kind of look at and focus on.
Yeah. The regulatory environment over the last 4 years has just been objectively brutal. And it is, we are for fintech CEOs. Our businesses are still, there's some overlap, there's still a lot of differences. And I do feel like everyone looked at fintech as it's all the same, they're all bad actors, we're gonna crack down on everyone, they must be screwing their customer, we have to go, we love putting out a press release of how we find this fintech that has publicity and users and the like. And so I do think a shift from that of, I got in this business to try to help people with their finances like that. We are a long only diversified portfolio, high interest on cash, low interest on borrowing, like sort of fundamentals of basic wealth building, and being able to segregate that in the, I guess, not looking at everything the exact same way would be a benefit. Being able to say who are the good actors, encouraging good outcomes, who are the bad actors, potentially promoting bad outcomes would be a turn in the right direction. I do think, we're in Las Vegas. This is the mecca of what wealth is created via gambling, and it's not for the gamblers. It is for the casinos. And I do think there are a lot of companies out there that, we talk about it as investing is very different than trading. They both start with buying a security, and so they have similarities. But when you're buying at 10 a.m. and selling at 2 p.m., that is not investing. That's not buying intrinsic value of the underlying fundamental thing. That's trying to play random price movements. And I do think there is, I think Sarah, you talked about it a lot. There's a lot of promoting of the gambling behavior in financial services, and it's exciting because on your couch you have the possibility of making a lot of money or losing a lot of money very quickly, and you don't have to fly into Vegas to do that.
I think the prior administration, to your point, it did apply a paternalism, right? Trying to protect people from doing the things they wanted to do because the government might know better than they did. Crypto is probably the clearest example where there was a very clear retail demand, and ultimately I think that outlasted the administration. But there were plenty of other examples where, at least with respect to our primary regulator, the SEC, a desire to change the fundamental rules of market structure to try to kind of create in a petri dish a new type of market interaction. So I think in the new regime, we're likely to see market forces, whether it's people offering different types of experiences to different users or products that are suitable for some types of investors and not others. I think we'll see more of that diversity blooming, and those that are successful will get adopted, and those that aren't will not.
So since you brought up crypto, what are your views on crypto today and where the market stands? Are these still primarily speculative assets, or is there an actual use case for them?
Well, crypto it's a good example of something that was in regulatory winter and now is getting a lot of sunlight. So I think we'll see a lot of innovation in this space over the next several quarters. The clearest use case for our business would be to use stablecoins as a funding mechanism for settlement, particularly for our partners that are based many time zones ahead of the United States. To settle for T+1 requires them to move quite swiftly over the traditional rails. So I think that's one area where there's a very discrete use case that we're likely to put into place.
Anyone else want to jump in on crypto?
I would argue crypto as an asset has matured a lot. And we see that from a perspective of the people who are buying crypto, the sizes that they buy crypto, more holding behavior than just pure trading, and so on. And I think you're also seeing how the industry around that has matured. Like I think the minute Trump came out with like his first kind of true social post on the crypto reserve and so on, and then actually seeing some of the influential people in the industry to kind of go back and actually criticize that first iteration of it, I think was actually a very good sign that kind of shows how the industry has grown up. And our crypto, generally speaking, is just much more mature than it generally used to be. You still have your meme coins, you still have that stuff, but even with that, I would argue that even when it comes to meme coins, that most people, at least nowadays, know that there's no value behind it, that it's all just a weird pump game that you maybe shouldn't take part of, but if you really want to have that fun, knock yourself out. It's a free country. But at least people generally know that, right? Like a few years ago, you would have tweets going around basically saying like, oh, Dogecoin is going to be the next currency and so on. And people,
they might have been right.
And they would be, not be right, but bad example. And there would still be people who would take that stuff seriously, right? And you will obviously still find those somewhere. But generally speaking, I think it has matured a lot. There's more sanity than there used to be, and so I think generally speaking, we're all kind of
I was
in the right
almost
direction.
with you until you made that sanity point. So I think it is largely speculative, and I think it is high volatility and it is high risk. That being said, the advent of ETFs in the space around Bitcoin, Ethereum, and then maybe a few more to come suggest that there is a regulatory environment building around a subset of the asset class. But I think to Michael's point, like there are maybe one or two clear use cases at this point, but there's also a lot of speculation, there's a lot of crime. And so I think we have a long way to go from where we are today to winnow down and sort of separate the wheat from the chaff, or whatever the expression is, right? I mean, I think that's still the winnowing to come, and we haven't seen that happen at all.
As the person running the platform, though, I wonder for public in particular, how you balance that desire to give your users what they want and then not burn them out or sell them lotto tickets.
For us, obviously, we're a self-directed platform. We don't give financial advice, and generally speaking, there are people who want to buy what they want to buy, and generally speaking, they should have the ability to do so. Now, where we see a responsibility for ourselves is to give people as much context as possible around the markets and the assets that they invest into, and that falls at company data, that falls into understanding that certain coins are very risky, right? We have risk labels on all stuff. We literally invented a thing called safety label, which then a bunch of other investing apps in the country have copied, by the way, FYI, and so on. And so we see our responsibility very heavily in giving people context, but we're not in the business of telling people what to do.
I feel like we've been talking primarily about retail, but from the institutional side, do any of you have a view into institutional acceptance of crypto? You mentioned the ETFs, for instance.
Yeah, we're seeing a little bit of adoption through, so one leg of our business is we're a SaaS platform, a custody solution for RIAs, and we're seeing it's very bifurcated, right? There's a handful of RIAs who believe that adding the crypto asset class as part of a diversified portfolio works for them, and then there are tons of advisors who are still advising their clients, don't touch it.
I think you'll get much more regulatory clarity, from all of the disparate agencies over the next several quarters. And I think we've seen the OCC put out something. I think if SEC and FINRA do that as well, you're going to begin to see, an ecosystem where people don't have to worry about feeling the risk of being rugged. I mean, traditional finance, for all of its inefficiencies, does get tremendous value out of that segregation of duties between a broker-dealer, a market maker, an exchange, a clearinghouse, a custodian. We've seen in crypto what happens when you combine all of those into a single entity. So I think bringing some of that traditional structure and maturity into the crypto space will create a lot of value.
Yeah. super skeptical of the utility of crypto, and I do think a lot of the crypto assets are more regulatory arbitrage, where a lot of the things that people talk about, the benefits that could be deployed using crypto, it's not the technology that prohibits a lot of those usage, it is the regulations that, people talk about the tokenization of private companies or stocks. That's a very solvable problem with existing technology. We just have the IPO process, and you have to go through certain things to be able to sell to a public audience. And so to me, I think the thing that I would love for there to be parity in sort of regulated financial services and unregulated financial services, and say that be technology agnostic in terms of what supports it, but not say that if you're regulated, man, we're going to make it really hard for you to do anything, and then the unregulated space is the Wild West and do whatever. And I think you get sort of, you see the outcome of, of what that stance gives you. It's the regulated space. It's very hard to serve your customer as well as you want. It's very hard to modernize. It's very hard to bring the latest and greatest in technology. And then if you get, if you push everything outside the system, you do get the meme coins. You get pump and dumps. You get people. You just invite the bad actors who can make a quick buck on it.
So beyond crypto, I want to talk about other alternative investments. Private equity, private credit, venture. There's been a lot of interest to be able to buy into that on the retail side. I'm wondering, what's holding that back, and do you see an opportunity for that to actually, those types of products to actually become available?
So for our customer base, I would say that the opportunity in alts is really around illiquid assets getting a premium because they are illiquid. And I think that the average customer doesn't necessarily have the means to be able to weather the storm of that illiquidity. And some of the products that have come to market that are actually more liquid have incredibly high fees and don't offer you the same kind of opportunity from a diversification standpoint. So I think at this moment we're watching, but I would say until costs come down, I personally believe that more of the interest is on the supply side because they've run out of institutional places to sell, and that they now want to push this on retail investors. And I think that, like crypto, there's an education layer that will need to be included to make that productive for the average investor.
For our platform, we've many different types of partners, and sometimes when people are migrating to DriveWealth, they have existing assets that might include alts, and so they need the ability to support that. So we now cover equities and fixed income and options and funds, and I anticipate we'll add alts before the end of the year.
We were joking beforehand of, is democratization going to be used on the stage? To me, I do think the best that finance has to offer is the private bank. And it's even in the name that it's private, and that means it's not accessible to most people. It's this sort of other door over here. And, I do think the aspect of the private bank is they're going to give you access to alternative investments that the general public doesn't have access to. And there is a fun thing of the they're not YOLOing into meme coins in that private bank. They are buying into the alts, the VCs, the PE, what have you. And so I do think there is an aspect of, if you can open up access to say, you don't have to have a certain wealth level, you don't have to have a certain exclusivity and access to have the same financial opportunities as the ultra wealthy, I think that's a net benefit. And so the more that there is innovation in the space to open up alternative ways to invest in things that have historically only been available to the ultra wealthy is a benefit to the retail customer.
And it comes back to regulatory things around it, right? Like the whole accreditation process, I think is kind of screwed, to be honest. Just from perspective of that the system is centered around the person versus the assets that the folks are offering the assets and so on, and that you're basically just based off wealth defining if you have the ability and the intellect to invest in something. I think is kind of stupid, to be quite frank. And so I think that's, for example, one aspect that needs to kind of change. And then I think the other aspect is, as it comes to kind of private assets, some sort of regulation that defines of like what types of financial disclosures have to happen, et cetera, so that these things can be traded more openly than they are right now.
I feel like the big buzzword is AI. Everyone is talking about AI. I'm wondering how each of you is using AI in financial services today, and sort of where you see the opportunity in the next 3 years, the next 5 years.
So in the immediate term, we're using AI everywhere, I would say, but more as an internal efficiency play, kind of point one in every area of our business. And then secondly, in customer care. So a lot of customer service and customer experience interactions are being either enhanced or sped up by AI. I think the opportunity that excites us is advice. And whether or not that is actually AI-driven advice, or whether that is just AI enabling the scaling of advice, so there still may be a human layer. I think those are some of the details that that are in the mix. And coming back to your question, sort of your regulatory question, I think how the regulation evolves in this space, particularly as an RIA who is regulated by a fiduciary duty, is a pretty complex nut to crack. So I think that's where we're excited though, and we think that there's real opportunity.
It's really good at writing a year-end performance review. That's my primary use case. No, we use it in a similar fashion, right? To give engineers more efficiency in the work they're doing for our customer care, and for some onboarding activities. But until there's a clear path for a regulator to permit an AI to provide advice, AI-generated content is just going to be content.
Yeah, I'll go for it.
Is that it? One side, operating leverage, right? Just like make your company be more efficient by actually adopting AI tools. We just had management also literally last week where we were like very harsh on people, just like play with these tools, like force people to actually try the stuff, and and if it sucked 6 months ago, it might not suck today. Like keep at it, because I think there's a lot of efficiency to be built. We just literally produced like a whole TV spot completely in-house, just 2 guys in the closet, so to say, and half of the footage was AI generated and so on, and looks fantastic. And so there's a lot of efficiencies being gained just to kind of essentially do margin expansion for yourself. And then the other piece, obviously from a user-facing perspective, we have within the public app, we have Alpha, which is like an AI agent that you can essentially push and pull. So on the one side, you can just swipe down on any stock and ask any question about that stock. And then also it kind of feeds you context around the markets, right back to context, where let's say there was an earnings call, you get an earnings call breakdown in your inbox, literally the minute they hang up. Or for example, like the chart is moving in one direction very heavily, it gives you a little card of like, why is this stock moving? Like what's happening? What's driving this behind it? So you understand, if you look at your portfolio and the chart points down to the right, you're not like panicking and panic selling and maybe doing something stupid and wrong, but you get the context and while you're there. And AI does a lot of great things there. And I think the next step for us there is, again, for looking at that spectrum that we talked about earlier, is like as we move more up that spectrum, AI will play a massive role in helping people manage their portfolio. If that is actual advice or actual automated management, or even just being that sparring partner as you kind of construct your portfolios and make changes to it.
Yeah, I'll take the bold. I think this is going to completely upend the industry, and this is my hobby horse, and I probably get too excited about it. I already talked about the private bank, and if you have 10, 50, $100 million with someone, you get a relationship manager and a team of experts behind the scenes, and they optimize every aspect of your financial life. Every single penny that comes into your ecosystem, they're directing towards where it can be best used. I think that's very close to being replicated for like $10 of compute each year. And so, this idea that you were gated behind having massive amounts of wealth or 1% of your net worth getting paid to a financial advisor, I think you're going to get, whether it's 100% of the same client servicing or 95% of the client servicing, I think it's going to be 1% of the cost. And so, this idea that every single person has a financial expert on demand for pennies on the dollar, I think is just a huge, huge, huge opportunity. And this is where I'll go back to my regulatory stuff. I think it would be a travesty if we delay getting that into customers' hands because it's only 99% accurate rather than 100% accurate. I think that's a huge, the person with $50, $100, $500,000 who can't get a good financial advisor because they don't have the wealth. I think it would be a travesty if we said, we're protecting you, the paternalism, where you need to do all the research on your own. You need to overpay people because this AI assistant is going to be right almost all of the time, but it's going to hallucinate from time to time.
But for that 1%, you're messing with people's money, right?
You are. I think
Sometimes human advisors have been known to make mistakes.
Yeah, no, it is. And, I think the analogy is like the self-driving car. And cars, 40,000 people die in automobile accidents every year. And if it's something that we handed over to self-driving cars and that number went down to 20,000, the press would be self-driving cars kills 20,000 people, not self-driving cars saves 20,000 lives. And so, to me, I fall on the saving side of lives, and I fall on that side on the possibility of giving very, very high quality advice at a fraction of the cost to vast amount of more people. And I worry that it's not going to be, it's going to be a lot longer to be able to do it from a regulatory perspective than what the technology allows.
There's also a thing of humans are driven by incentives. And, if your incentives are to sell you some shit you don't need, but you make a bunch of money on it, chances are they will. And I'm sure there's a bunch of financial advisors out there who do that, let's be straight. And by default, in AI, is not driven by incentives. It's only if the human behind it, says it should be. But other than that, I would say it's even that the AI actually has less bias and is less incentive driven than the human might be.
Okay, final question. What is one big prediction that each of you has for this year?
Start down there.
I'll continue on the thing. I think the general AI models are coming as like general assistants. I think someone's gonna, someone, hopefully us, we're definitely trying. I'm gonna launch a incredible financial assistant for a fraction of the cost of what a human would be.
Man, a big prediction for the year. I don't know. Verstappen is not finally going to be always first in F1.
I hope you're right.
Yeah.
I think the trade war saber rattling will diminish, and we will get back to a growth-focused economy.
That's a good one. I was trying to think about Russia and Ukraine, but that's a tough one to predict. But certainly by the end of the year, I think that will be a war that will be in the rearview mirror.
Okay, well, let's hope so. Thanks, everyone. Give everybody a round of applause.